Hello, Maverick traders. Welcome out to your currency midweek for April 12th. Corey here with you. Let's jump into this week's events and see what's moving markets. CPI came out this morning, and that was a big hurdle for the markets to get past. We've talked about how that CPI, the inflation numbers, are going to naturally move lower, and we'll look at that a little bit further here today. So stocks are moving higher. They've been pushing through this whole bad news, banking crisis, all of these sorts of hurdles. And there's an old saying that risk or stocks climb the wall of worry. There's always something to be worried about when you really think about the financial markets and risk taking. It doesn't matter what decade, what year you lived in, there were health concerns, there were geopolitical risks, there were wars, there were rumors of wars. It's just the world we live in. And so that doesn't mean, again, bad news does not always equal good or bad price action. In this case, there was a lot of bad news, yet stocks were moving higher. That is what we call a market tell, and you want to be very aware and pay attention to that. It's hard to be a buyer in that environment because it will make you scared, it'll make you nervous, but you have to get used to doing it. You have to do the things that make you feel uncomfortable. And if you're not there yet, you've got to push yourself and you've got to get past those limits and you've got to do what's going to ultimately build profitability for you in the future. US dollar's been in a short-term downtrend and it still looks bad. I think US dollars should continue to trade lower. The safety trade is coming off. I was wrong about the precious metals part of that, but I was right about the rest of it, that ultimately the US dollar coming off, that some of these safe haven areas are seeing some liquidations, that risk taking was going to continue, and that's been the case. So basically more risk taking, less of the safety trade, and that's been in place. Now, the news this week was all about the CPI, and we saw a huge reduction in annualized CPI from 6% to 5%. How does it drop one full percentage point in one announcement? Well, here's how it works. So we've talked about this before, but remember the annualized number went from 6 to 5. How does that happen? If you look at the month-over-month numbers, and we zoom in here, we just got a number at 0.1. Go back a year prior and look at this April number. April 1 year ago, we were reporting a number at 1.2%. In essence, you can see the full 1% drop because we're getting rid of April last year and we're adding a low input this year. And that takes our annualized number down to 5%. Well, let's look out in the future. Next report, we're not going to get rid of as big a number, but the next two that follow that. So basically over the next three, we're going to get rid of two monsters here. In, again, the May number, not so much, but June and July, when we get into the middle of this year, we're going to continue to see a huge drop and reduction in inflation. Now let's make a guesstimate. Let's say that May comes in here, you get a mild drop. You go from 5 to 4.8 or something. And then let's say that inflation's here and it's here or whatever for the next couple of months. You can see this huge drop there and this huge drop there. We're on target to be at about 3% over the next 3 months if the coming inflation numbers come in tame and relatively low. Now, this is important. The Fed, I compare the Fed to a golfer that just hit the ball in the water. They screwed up inflation so badly by saying it was transitory and keeping their foot on the gas and letting inflation get out of control. They screwed that up so bad that now they have to err on the other side, which is being too hawkish, driving down rates, or driving up rates, driving down economic conditions, trying to drive down inflation and so forth. And I'm not going to give them a ton of credit here necessarily because there's a very good chance they're going to err on the other side, which is They're gonna let inflation go too hot, and then they're going to fight it too long. But you can understand from their standpoint is they have to get this one right because they screwed up so bad the last time. It's sort of like a trader. I always say that your mentality, when you are trading well, you feel really confident that you're seeing things clearly, that this is a good setup, that you've got a good risk to reward. When you're trading poorly, you're remembering how bad you screwed that one up, and the next one just becomes a little bit more, you're less likely to be seeing things clearly, you're less confident in yourself and your ability, and the Fed's kind of in that mode where now they're not even going to trust themselves and what their eyes can see and so forth. So it's just sort of a mess that they've gotten themselves into. But naturally we should see inflation just over the next 3 months coming up. We should continue to see a big drop in that annual inflation number. So that's important to understand that. We've talked about it a lot here. It's probably not the last time I'm going to talk about it because it's important in terms of where markets are at. Now, here's my thought. Here's how I think, and I try to spend time, I don't know if you'd call it meditating, but I think about the markets a lot. I think about how are people positioned? What's the sentiment? What is the market doing and pricing in that I think they have wrong, that I think they have right, that I think will continue? Where are people getting hurt? Where's the pain trades? I try to think about this whole big piece, every piece of the pie and how it fits together, if that makes sense. So see if this makes sense to you. This is my personal thesis here. We know inflation right now is at about that 5 and it's trending sharply lower. And the Fed's been battling that. And let's say that it's headed towards 3 in that June to July-ish time period. What I think that also correlates with is that the Fed raising rates, there's a lag effect. It's not like you raise rates and instantly the economy slows down. There's a big lag effect in how all of these things hit. And I think inflation is coming down at this point, and sort of naturally so. And we're in that period where this is cheered on, and hey, we've got the economy still chugging along, we're fine there, and we're seeing inflation come down. But I'm thinking about this June to July period when you see the huge drop that's going to come. Remember, we're getting rid of the two biggest numbers in June and July. And what I'm worried about is that the economy, and we're really going to start to see a general slowdown in things here. Again, lag effect, and we're dealing with a transition to higher interest rates and so forth. The quantitative tightening is still in place. And about that period of time when inflation's really dropping and maybe the market has gone up and it's still looked okay. And I think it'll turn before this, by the way, but let's say it rallies for the next month or so and now you're coming in and you start seeing this big drop in inflation. I'm picturing this scenario where the market starts to turn down going into these. And this would be the confusing and the confounding of the masses, because most people would say, well, now inflation's coming down. Now the Fed's closer to its target. Why are stocks going down now? And I think they're going up, pricing in this inflation ahead of time. And as we're moving into that June period, I think they're going to start to get slammed. And that's where people will essentially be misled and confounded and say, well, now we've got all this good news coming in. Why aren't stocks going up? It's going to be more about the economy. And my guess is that the economy will start to slow, but it won't be out in the numbers yet. And then you get into August, September, October. That's where you're going to start to see the economy rolls over here. You won't see it in the numbers until out here, right? There's always that lag effect. So my guess is that I'm fairly nervous about the markets if you go out a month to two. I think we're going to see some heavy drops, some big drops, some massive unwind. I can imagine anything that's risk related. Like I would think that maybe Bitcoin is really getting hammered in that period of time. That I don't know about gold and silver. I'm going to hesitate to make any big call on precious metals here, but I would say the risk taking side of it. And Bitcoin has traded more like a high flying tech stock than anything else. Crypto in general has. The other cryptocurrencies much more than Bitcoin, by the way. But I think stocks, I think anything that's more on the risk scale is probably going to hit. Now that's a future. I think we can continue to run higher in the short term. I think we're in the sweet spot where the economy's okay. We're seeing inflation coming down. But a month or so from now, I really wonder if the market's going to start to tumble over. So we'll see. We'll try to make sense of it as it goes. I always trust somewhat that I'll know it when I see it, that when that time hits, I'll trust that I'll see that, hey, people have been pushing risk assets up, and now there's big signs of exhaustion up here and what we call capitulatory highs and so forth. I would suspect that that would be the case. Now, here's the flip side of that. We'll have to look at where the US dollar is at that period of time to really make a judgment on the dollar. Naturally, one would think that inflation has come down a lot. Let's say it's trading at 3%, and the economy starts to roll over, the Fed will cut rates. And they will. They'll cut rates at some point. I don't think they'll cut quickly. I think, again, they have to err on the side of being hawkish. And that's where they would be put in a tough spot. Can they start to cut rates if inflation is 1% above their target, if the economy starts to show weakness and the financial markets start to show weakness, stocks and things start to get hammered? And that's the conundrum that I think they're going to find themselves in. Now, one might say, well, the Fed cutting rates, well, that would be bad for US dollar typically. Again, I think they're going to be in that tough spot. So I would kind of envision that US dollar trades lower right now. And then I think what would make most sense to me is that down the road, that month or two from now, when I think the market really starts to get hammered to the downside, I would expect US dollar to strengthen on that. Even though it would lead people to believe that the Fed's going to cut rates, I just don't think they're going to be as quick to cut rates as everyone expects. So we'll see, but that's kind of the thesis that I have floating around here, is that I think we're going to enter into a huge risk-off period for the markets. But the pain trade is still to the upside in stocks. That's important. I'm not calling for, to rush out and short everything in stocks or anything like that. I think we're a little too early because this pain trade has to play out. So if you ask my short term, I'd say, well, short term, I think stocks can continue to work their way higher, but on an intermediate basis, I think we're going to have some ugliness coming down the pipe. Now, Bank of Canada kept rates unchanged at 4.5%. Last week, we talked about the Kiwi, and this is worth review. There was really only one currency that really stood out. Let me actually use this instead. I think this will be better. But Kiwi was just beautiful. Exactly 1 week ago, we were forming this candle right here. We had the shooting star. This is what was happening Wednesday of last week when we were live in class. And it was my thesis that this was a false breakout, that this was an opportunity to get short Kiwi. From false moves come fast moves was the thesis that I had, and I thought Kiwi could go on a slide. And this was as good a trade, as good an opportunity as I've had all year, actually. It just went straight down. I mean, that was picturesque, picture perfect. The obvious trade on that is probably Euro Kiwi, which worked perfectly. I think there was another. I think actually Swiss franc against it would have made a little bit more, but Euro Kiwi was just phenomenal. So if you look at Euro Kiwi on the trade, there it was a week ago, and just from 173-ish to 170, I mean 400 pips almost in a straight line. So Euro Kiwi was a good one. You could have traded Kiwi short against anything. But this is the kind of where we're at, I think, in this cycle. What's interesting is the Aussie, so the Australian central bankers are acting different than the RBNZ. And who has it right and who has it wrong? Well, what's interesting about it, again, sort of the counterintuitive thesis a little bit. I like the short setup in Kiwi. I wonder if they're getting it wrong in essence, and that they're going to have to start cutting back. Whereas the Australian central bankers didn't raise, may not be able to cut, and so forth. But this is more at risk of maybe getting it wrong from an economic perspective and what you're seeing in inflation. And if inflation's coming down, it wasn't anything too scientific. I knew inflation was going to have a big drop this week. It was expected to drop by 0.9. It dropped by 1%. I think this was going to scare those Kiwi traders in essence that, hey, rate cuts might be coming from the RBNZ sooner than expected and so forth if these inflation numbers continue to drop. So I thought this was the more vulnerable currency to a big drop. I mean, Aussie's already priced in. They didn't raise rates as aggressively, right? They did, and they're at more risk of having to cut more aggressively in the short term. So it was really just a nice mix of fundamentals and technicals coming together and a nice opportunity. Let's take a look at a few different numbers this week. There's not a lot happening. I'd call this a quiet week so far. Basically flat in the S&P and international markets. Crypto up 3, oil up 3, gold flat on the week. I made a little bit of a bet with Rob at the start of the year. I said oil would be higher for the year. He said lower for the year. We still got a lot of year left. I said at the time I liked oil early a lot more than I like it late. And oil's up, so far I'm winning that bet. The problem for me is going to be what transpires with the economic slowdown. What I love about oil, though, is it is moving to the beat of its own drum. And I really like that let me rephrase that because I hate that the U.S. screwed this up. I despise it. But what I like for oil's sake is that the U.S. tapped into the Strategic Petroleum Reserve. Then they didn't refill, which I think was just a boneheaded mistake. I don't know what they're doing, but anyway, maybe they'll be geniuses and I'll be the idiot. That's entirely possible, but I think they screwed up. Now, if oil goes down to 40 and 50 a barrel, they're going to be the genius and I'll be the idiot, okay? Let's be very clear about this. But I think oil is higher and they still haven't tapped into that. So even if the economy slows, I mean, we might have a really bad recipe where oil stays high, the economy's slowing, uh, inflation still in the threes, and they need it to be closer to 2, and it's just a cocktail of messiness. So it remains to be seen. I do worry about oil from an economic standpoint, but I have to say, I hate if you said lose the bet and have them fill up the Strategic Petroleum Reserve. I would take that switch. Okay, I'd rather lose the bet and have them do the right thing, but that would benefit all of us. I think they screwed it up. We'll see. Time will tell, right? Ultimately, price is truth, and where the prices go and where they fill that up will detail how well they did on this thesis. Let's take a look at a few different things here. In the S&P, what would you say, forget the name, forget the symbol, what would you say of this chart? Okay, take your opinion, set it on the side. Don't come in with the bearish negative outlook because you don't like this or you don't like, just look at the chart. You'd have to say it's more bullish than bearish. We're trending higher, we're above the short-term moving averages, we're about to form a bow tie pattern, right? A bow tie pattern is where the moving averages cross and then recross, kind of looks like a little bow tie. It's basically that the correction is finished and a new uptrend has emerged. Now, in the short term, I think that is in essence exactly what we're doing. We're pushing to the upside, and we're probably going to go a little higher in the short term. That is the hardest thing to do, is probably to continue to buy stocks. That probably makes it the right thing to do. The pain trade still seems like it's to the shorts. So too many bears, too many people short this market, and the market will go down. It absolutely will. It'll probably start to go down when everyone stops betting on it going down, right? When those shorts have capitulated, thrown in the towel and said, I can't take the pain any longer. That's probably exactly where you should get short. As we look at currencies, these two just continue to be pretty darn stellar. You have to give the euro and the Swiss franc just doing their thing, just acting well. Kiwi, like we said, has been a great short. Yen is a little tough for me. I'm just not trading yen at the moment. I've had a thesis that the yen will have a pretty good year when it's all said and done, with a lot of weird volatility and policy changes out of the Bank of Japan and so forth. I think the market's continuing to kind of pressure them. You've seen them have to make some adjustments. They've had to change some policies that kind of forced by market actions. And I think that's going to continue, but I don't have an opinion on yen right here. My guesstimate would be that when we start to see, again, a month or two from now, if things are starting to get really ugly, yen should do well in that environment. Yen should catch a bid, and that should be a period where we say we want to buy yen against almost anything, in essence. As we look at crypto, good week this week, up. I worry for crypto that maybe it's a little exhaustion high, so we're going to take a closer look at that as well. So let's come into some charts, and since we talked about Bitcoin right there, let's just see if this makes sense. So if you look at Bitcoin by itself, maybe it makes a little bit more sense in essence, and maybe even here's an ETF where it kind of stands out, but it's the same principle on all of these charts. If you look at Bitcoin by itself, if you look at it on that ETF, they all have that same look. Where is this just a continued breakout? Could be. I mean, it looks like it's just breaking out. Or is this an exhaustion? And what you often find, I use the analogy of running a race in that, was this enough to rest? Probably was. I mean, maybe we're overestimating this, but in essence, I think Bitcoin is probably going to pull back into the range. That's my personal philosophy. I haven't wanted to get short Bitcoin, but I haven't been buying it aggressively either, which was the wrong trade. This was a breakout that accelerated quickly, and now we've spent multiple weeks consolidating. Now we're breaking out again. It doesn't have the same upside momentum and pressure. Yesterday looks like it could be a little bit of an exhaustive type of move. If you kind of look at where we're at, in fact, go to the 1 hour or something, we tried to accelerate again right here, and just a bit of a failure. You can see how it's fallen back. So my personal opinion is that this one's going to be, I'm going to call it a very mini false breakout, meaning I'm not calling for Bitcoin to collapse here in the short term, but I think we're going to have a little pullback back into the range. You'd have to have a new influx of capital to come in and take that risk to the next level from this 30,000 level. And I think 30,000 is a key psychological number. In trading, sometimes numbers that end in a big whole round number like that really stand out. Where, see how it pierced below 20,000 and then that was the bottom, right? So it actually broke, it did trade below 20,000, but then we spiked back above it. That I would call false breakdown, right? And then you accelerate. Notice here we've pierced above 30,000, so you have broken through it in essence, if you're just calling it a 1 day or so breakout. But I think that's what it is. I think it's a trigger stop losses, kind of flush some people out. And then I think we sink back into the range. So I personally like the Bitcoin, the cryptocurrency short here. And I have not stuck my neck out there to say, let's short it right here, right now for months. But I think this is a trade. I think it's very viable. So I would be short, trading it towards 28,000. You could put a stop up here above the highs. It's not, in essence, everything has risk, right? We're always trading risk, reward, probability. I would think that would be the idea, the thesis there. So you can short Bitcoin a few different ways. If you understand the futures markets, you could do it through futures as well. You can short Bitcoin futures, go long futures. There are different platforms where you can just buy Bitcoin directly. There's not as many platforms for shorting, but you can do it through a few different avenues, basically. All right, let's get to a couple other looks here. So US dollar, we had a request and a question about. US dollar, I was looking at this earlier and I mentioned this, that I think it's still a short. That's what it looks like. So it's got that, opposite of S&P type of look to it. When the S&P's been trending higher, this has been trending lower. The S&P had a bullish bow tie. This is a bearish bow tie, right? The cross above and now the cross below. And look at how it failed right where it would have, could have, should have, right against those moving averages. So if I'm right about this thesis coming up, there should be more risk taking in the near term for stocks specifically. Again, I don't like crypto here. I also think, and I've been wrong, by the way, I took a stab at a gold short and I thought I was a genius because I made money on the first one. Then I lost more on the second one. So net, I lost a little bit trying to short gold. But I think gold and crypto both look to me like short-term exhaustion highs. So full disclosure, I am short also gold through GLD, playing it to the downside right here, right now, which probably sounds stupid. And we can look at that one as well. But basically, I think all of those are kind of a defensive trade where money piled into them. It was like the anti-bank type of idea. Get out of banks, get out of currency, get out of whatever, and go to safe havens. And they use gold, but they use Bitcoin and some of those things. Well, I think US dollar is kind of the same thing. It's a safe haven area as far as a currency. Let's look at gold since I mentioned it. I was wrong. I thought that we were having a little mini exhaustion here and it just popped right back above and stopped me out. But I think I was early, not so much wrong in that, see the breakout took place back here. This is where the race began. And then we continued to accelerate. And now I think this is a little sign. Again, I'm just calling it a mini. There's huge signals and there's short term, like little mini signals. I got short GLD today. I'm probably, where am I at in that? I'm probably break even-ish. I mean, but I basically got a stop right up here. And I think we're going to just sink in crypto and in gold back into this range. That's my thesis and that's my trade. If I'm wrong, I'll get stopped out quickly for a small loss. If I'm right, these will work their way lower for the next week or so. And ultimately, as is always the case, right? The markets, the price is truth. I'm going to be right or wrong, and the price will tell me. It's like handing in your homework assignment to your teacher. They're going to tell you whether you're on the right track or the wrong track. Well, if I get stopped out, I had it dead wrong. I need to go study more on these and not keep trading them until I'm seeing it more clearly, right? I don't want to go into a test if I've been getting the wrong answers on the assignment. So we'll see, but I think those should work their way back into this range. And I'm calling them very, very mini exhaustions because once they have a little deeper correction, which is very normal within the cycle, if you think about wave patterns, okay, just think about Elliott waves. Well, we've made a wave to the upside. Now there should be a wave down, right? This very well could be one wave, and this would just be the second wave before you start another big one. I've got no qualms or problems with that. But normally, you don't stay extended away from the 20 period moving average and these levels that long. You get a correction, which is what these waves look like, right? So there's big waves and there's more minor waves. And here I'm trading a more minor wave. This is only from here to here. I mean, that's not massive on the longer term scale of things. This is like a very minor drop in the bucket compared to how gold has traded for centuries, right? So, but nonetheless, I think we should have a little bit of a correction here. And if that's something I can take advantage of to make a little money, great. If I'm wrong and this wave is not done and we just keep getting that next influx and then that next influx of new buyers, well, then I'll be stopped out pretty quick at a small loss. So I'm not risking much on it. And it is counter trend. I don't love counter trend trades unless I feel like it's a good risk to reward and it's counter sentiment. And that might sound confusing, but if I take a counter trend trade, it's usually because I think sentiment has gotten ahead of itself. And this would be a case where I worry that sentiment has gotten ahead of itself. Every Tom, you know, every Joe, every Steve, every William, whatever, every Sally, every Sarah, everyone in the world right now, it sort of makes sense in their brain that, hey, banks are risky, runs on banks, worried about financial markets, worried about crisis, worried about whether your money's even safe. All of a sudden, gold and silver sound pretty good, right? And that's true for, again, everybody, right? So just random individuals. So sentiment is quite high on these precious metals because they say, hey, this is an alternative to all that mess. Now, I don't need to be right for a long time. I just need a shakeout where some of these people sell into it and go, oh crap, and the Johnny come latelys, the ones that were buying too late in this wave, should be shaken out a bit, and then it can start all over again because the underlying thesis might be a good one. It might be long term a good idea to buy gold. In the shorter term, again, I worry about the sentiment shakeout, the little correction here, um, and that's what I'm trying to take advantage of. So we'll see if it works out. What happens if the inflation gets stabilized at 4.5? How could this affect people in the markets? Well, so now that would be even worse in terms of possibilities, right? Because now you have a really higher inflation number, and the Fed wouldn't be cutting rates aggressively at a 4.5 inflation number that was staying steady and sticky there. So that would be even worse. And I'm giving the markets credit to say the inflation could come down into the threes, but still way too high. If it's at 4.5, that's even probably worse for risk assets, would be my thought. Could you please look at Euro USD long trade on the daily charts? Yeah, absolutely. So let's pull up Euro USD and take a look at this together. So I like to work my way in on charts. First thing I would do is, it's pretty clear where old resistance was, right? And we talked about Euro USD. Remember, we talked about how it didn't quite touch, but we thought that that was probably the cup and handle. You see what's transpired? Exactly the way we had thought. We said, look, if it was going to be perfect, it would have gone up just a little bit more before this. So remember the math, and I don't remember the exacts on the math, but I'll bet you I basically said, here's 110 at the highs, and here is the cup. Okay, we'll draw that out, and that's down here at 105. Let's just call it 105.40 or something, somewhere in that neighborhood. So if you do the math, what's the size of the cup? Well, the size of the cup is the difference between the peak and trough, right? So 110 at the highs minus 105.40-ish. And this would be pretty darn close to the math we were doing when we talked about it a week or two ago. That's 460 pips. And I remember doing this live together. Hopefully you all remember. And then we said, well, the handle should be about 30% of the size of the cup. So what's 30% of that? Times 0.3. It's 138 pips. So from 110, if you go down 138 pips, okay, I'm just going to write it out here, pull back about 138 pips, what would that put us at? Well, let's see. It would put us at 108.62. 108.62. Look at exactly where the handle came in. I mean, it's not science in that it's going to give you the exact number. I always tell people, look, if you're doing the math and then you say, well, it should stop at exactly 1.0862, and if it goes 1 pip lower than that, then that's a deal breaker. No, no, no. It's, hey, it'll pull back to about 108.62. Does it matter that it went at 10 or so pips below that? No, heck no. If you're buying in the 108.62 level, any stop below here is probably safe, first of all, and you're probably not buying when it was initially kind of dropping to 108.62. You just wait for some little stabilization in there or whatever, and you trade this sucker back up. Now, this is on the daily chart, but certainly long and bullish on Euro USD. Now, if you want an upside target, we're back to resistance. We've got the cup, the handle. What's the upside target from here? You just take the 138 pips and you flip it on top. It's measured move, right? Here's this distance, flip it up there, and that would give you your target. So you can even go big picture, how high should this go? It should break out above 110 and go 138 pips, excuse me, higher. So 110 plus 0.0138 puts us up at 111.38. If you want a longer term target, where this thing's probably headed, 111.38. Again, not an exact science. You're not going to go up and hit that pip exactly and then trade down. That's the general area. Maybe you take profits at 111.25. Maybe you end up taking profits at, you raise your stop loss and you get out at 111.30 or whatever. Maybe you raise your stop loss and it blows a little through there and you get out at 111.64. But that's the general area that I would be looking to take profits on a longer term basis. If you wanted to be aggressive with this, and kind of envision where this thing can go in the short term, I think it's on its path. It's on its way to 111.38. So good stuff. All right, for the rest of this week, so we've got the currency recap coming out on Thursday. We traded non-farm payrolls last week, even with the markets closed. Nothing on tap for the rest of this week, so we'll have the currency room, the trading room, as always, coming out this weekend. Hope you enjoyed the class today. Have a great rest of your day, and we will see you next time. Goodbye, everyone.